The big voice this morning, Dr. Marc Faber, editor of the Gloom, Boom and Doom report. Marc, such a pleasure having you on the show today. Thanks so much for joining in. What are rising yields across US as well as Europe indicating about the risk that the world is running on?
Well, I think the financial markets were very fragile at the beginning of this year already. And this fragility has actually increased because we have a tendency of central banks stepping back from asset purchases and letting interest rates gradually adjust on the upside. And so this liquidity that we have in the world has been diminishing. It is not shrinking, but it is growing at a diminishing rate. And then came the announcement of the Trump administration, which I think is really a bad idea, to pick on China and to kind of launch not only a trade war, but a confrontation with the US largest trading partner, who also happens to be a large buyer of US assets, bonds, stocks, and of course properties. And I think this idea has disturbed the financial markets around the world. And so they are adjusting on the downside. Now, I wouldn't call that a crash. A crash was 87 when the market in America, when the Dow Jones dropped 21% in just one day. We've gone now in the US from a peak to the current level down by 7%. This is nothing. This is after an increase of the S&P from 666 in 2009 to the current level of we were over 2,900. This correction is really not very meaningful yet, but it may become meaningful.
Let's talk about, the risk at hand, which is what's happening with the EM currencies. The fall reflects also the gain in the trade-weighted dollar index, which is a broader index pegged towards, EM currency basket rather than, just the developed market currencies. Is the dollar buying seen as risk aversion or just better yield because the US is doing better than the rest of the world?
I think the question is more of this tightening global liquidity and the way emerging economies borrowed. They borrowed in dollars. And so there is a lot of demand for dollars to pay the interest on the dollar debts. Number two, when you look at international investors, they have some cash and they have some bonds. Now, if you look at what do they do in terms of money in cash and in bonds, they can buy US Treasuries, the 10 years now, at the yield of, say, 3%, but they could also buy in Europe treasuries. But the yield would be much lower. So, as an example, in Germany, they would get a yield of 0.5% on German governments. In Portugal, they would get 2.2%. In Spain, 1.66%. So the dollar compared to these European currencies and bonds is relatively attractive in terms of a yield. It's not particularly attractive as a currency because I think that some emerging economies have a much better financial condition today than they had, say, in the last crisis or in 97, 98. But if you ask me, what do you think about India? I think what I said the last time, I think the currency has become a bit oversold. and may rally a little bit, maybe to 71, 72 against the US dollar. But I think the long-term trend of the Indian rupee is down.
All right, so at 100, Mark, my question or a follow-up would be that why would rupee go to 100? I mean, 100 is still a distance away, more than 20%.
Well, the time frame is, I would look for a depreciation of 5 to 10% per year for the next few years.
The view on India, local factors are hurting, US interest rates are rising. What is leading to outflows here?
Well, first of all, India's fiscal position is not particularly good. They have large deficits, and they also have a current account deficit, as far as I know. And so either India has to increase interest rates meaningfully, which would mean that the economy would be hurt, or they obviously will have a weaker currency over time. And nobody can deny the fact that over the last 10, 20, 30 years, the rupee has been a weak currency.
So you do believe surely that there is more pain in store for the INR, right?
Well, as I said, I mean, I always applauded Mr. Ranjan as the governor of the Reserve Bank of India, for the simple reason that his objective was to have a stable rupee against major currencies. But the financial sector, of course, in India, they all bitched the whole time about Ranjan because they accused him of keeping monetary policies too tight. Because obviously these tight monetary policies are good for the rupee, but not so good for the stock market. And now what do they have? They have a stock market that became a bubble, and in dollar terms, the stock market is no higher than in 2015. This year, it peaked out in January in dollar terms. And we are down from the January high in dollar terms. The other day we were down by 19%, and at the present time by 17%. And this is because the financial sector essentially criticized the Reserve Bank of India under Ranjan that kept money too tight for their view.
Interesting thoughts there, Mark. Thanks very much for taking out the time.